You think the economy is getting better just because the stock market is hitting all-time highs, but the truth is you are getting poorer every single day you spend chasing a number that does not exist. If you are in your 20s or 30s right now, you probably feel like you are just trying to figure things out. You are making some money from your job, you have a ton of expenses, so you are spending it. Maybe you are trying to save a little, and if you are lucky, you are doing well. Maybe you are investing a little bit too. But there are a few financial decisions in this decade of your life that end up mattering way more than what most people even realize. So in this video, I am going to be sharing with you guys 5 financial decisions, or just like 5 money habits that will make or break your future. And if you can dial these in, you can get way ahead of the pack, especially if you are starting early. If you are 20, 25, or 30, you can really start to get ahead of people if you are smart about these 5 financial decisions. Before we jump into the video, go ahead and comment down below what is your current age and the amount you are investing every single month. Are you doing $500 or $5,000? Let me know below because your community is your leverage. So for me, I would say my best money rule is that I try to invest before I have fun money. I still keep a little bit of money for fun, whether that's going out to eat or going to the movies, Topgolf, whatever that looks like, right? But I always make sure to invest first, which has helped me out a lot. But go ahead and comment that down below and let's jump into the video here. One of the most disappointing things in retirement planning is seeing people who retire when they are told is responsible only to find out after the fact that they could have retired years earlier. And that's why the research I am going to show you today from Vanguard is so frustrating. Despite being well-intended, the way it is written can lead retirees to retire years later than they might need to and end up giving up some of their healthiest remaining years along the way. Vanguard has this retirement paper called Target Date Strategies and Advice: The Impact of Saving and Spending Differences. And this research points people towards thinking that they need to replace something like 75 to 85% of their pre-retirement income before they can safely retire. So that means they need to have generated an amount of savings or an asset pool that is large enough to kick off income that would replace roughly 80% of their pre-retirement income. Say someone is making $300,000 a year before retirement. Well, according to this Vanguard study, they would need around $237,000 a year in retirement income. And then if you try to use something like the 4% rule to estimate what size portfolio they would need, that would end up meaning they need a portfolio of nearly $6 million to retire, which depending on how you measure this, we are probably talking about the top 1% of households in the United States. One market sizing study found that only 1.5% of U.S. households have $5 million or more in investable assets. And so this basically creates a crazy, unrealistic expectation. It is no wonder people are frustrated and either feeling unable to retire or keeping on working beyond the age they would like to. Now, the problem with Vanguard's research is not that replacement ratios are useless. The issue here is that replacement ratios do not actually account for what people really spend in real life. And as a result, people end up thinking they need far larger portfolios than they actually do to support levels of spending they do not actually spend at. And then they spin their wheels building retirement plans that solve for the wrong number. So they stay at a job that drains them, they watch a friend or coworker retire ahead of them, and then think, well, I guess I am just behind in plain English. Broad retirement guidance like Vanguard's report can include a lot of good data and still miss the details that help you find your responsible retirement date. The first decision that I think is very important is how you handle your first real income. Now, you guys all know what I am talking about here. You go from making minimum wage to making maybe an hourly job that pays a lot more money, or you get a salary job. You are fresh out of college and you go from making $15 an hour to making $35 an hour before you know it. You are making $70,000 a year, which is a pretty big jump in income. And one thing that's really important during this phase of your life is that first consistent paycheck, you are starting to get sets a precedent as to what you will do later on when you start to make even more and more money. One of the most common things here is lifestyle inflation. So their income goes up and then their spending immediately follows that. They are buying new outfits, they are buying nicer brands, maybe they are getting a new car because they didn't like their old car even though it worked perfectly fine. They are trying to find ways to immediately upgrade their lifestyle to show this increase in income when in reality they don't need to and everything they had before worked completely fine. You should be asking yourself, do you adjust your lifestyle every time you get more money? Are you somebody that gets a promotion and let's say you make $15,000 more a year? Are you then going to spend an extra $15,000, or are you going to be the person that creates a solid gap between their income and their expenses? And they keep that gap getting bigger and bigger over time. Being able to recognize this behavior and trying to at least create a gap early on can help you out big time later on. I feel like I am a pretty good example of this because I used to be super frugal. Literally, my first apartment when I was 23 years old did not have a couch. I did not have a TV. I literally just had my desk, my kitchen, and my bed. But back then, when I was making $55,000 a year, I was still saving up to buy buy my first house. I was living within my means. Now that I make more money, I still am investing very consistently. I try my best to not let lifestyle inflation creep up every single year. One thing I always try to do is either find ways to save money or find ways to increase my income. The second decision that a lot of people overlook is whether you should build an emergency fund early on or just completely ignore it. The reason a lot of people early on don't like this is because it's a very boring decision. It's like, okay, I just have to save up a little bit of cash. The cash isn't doing anything for me. When in reality, life is going to throw some trash at you and it's going to cost some money and you are not going to like it, especially if you do not have an emergency fund, because what happens is that you are going to have to then either sell investments, which definitely sucks because that could be a taxable event, or you have to tap into debt in order to fund an emergency. You don't want to be spending 25% interest on a credit card when had you just had an emergency fund to begin with. You could just pull that cash out, pay for the emergency, and then try to replenish it. Even if you build up a small emergency fund of $1,000, that will at least reduce panic decisions. If you were to happen to get laid off from your job and you have a solid emergency fund, you are going to be a lot less stressed than the person that has no money saved up to the side and they still have to pay rent on the first. It's not about how much at first, it's about whether you prioritize this at all. If you can build up an emergency fund that is 3 to 6 months of your monthly expenses, that is normally a really good cushion to have. Now, the third decision is actually how you treat debt. There are some people that are like, no debt at all. I am going to pay that off as soon as possible. And there are people that just normalize it and are totally fine with constantly having debt. If you have high interest debt, if you are paying 25% interest on a credit card, you need to prioritize and get rid of it immediately. I have a buddy that just constantly has debt, has trying to optimize his debt, when in reality, has paying hundreds of dollars a month in minimum monthly payments, and all of that is just going straight to interest. The lenders love that because that's how they win. Debt doesn't just cost people money. It will actually limit your future choices because you have a lot less flexibility when you have a consistent couple hundred coming out of your account every single month. Throwing money at high interest debt prevents you from putting money towards savings or investing that money. And again, the interest is working against you here. So early aggression when it comes to debt and paying that stuff off early on will help you big time. Now, the fourth decision is when you start investing. It's not a matter of if you start investing. It is a matter of when you start investing. A lot of people go, you know what? I am not going to start investing until I am making $150,000 a year because then my investments will matter. Or they just get total analysis paralysis. Should I invest in individual stocks or ETFs? Should I hold gold or silver? Do I invest in crypto? They start asking themselves 100 questions, when in reality, all you have to do is just get started. When it comes to investing, time matters a lot more than doing things perfectly. Nobody's going to start out investing and just do it perfectly right off the bat. You are going to learn and you are going to get better over time. It is much better to start out when you are 20 and you are investing $100 a week than to wait till you are 30 just to invest $500 a month. When I started out investing, I was not investing thousands of dollars a month. I was investing $25, $50, or $100 a week. I do think you could at least throw yourself $25 a week to build your future. Another thing people do when it comes to the analysis paralysis side of investing is that they always tell themselves they are going to wait for the market to crash. The market's at all-time highs right now, so I am going to wait. Do not sit on the sidelines. The best types of investors are the ones that just invest consistently. They don't care if the market's at all-time highs. They don't care if the market's going to tank. Always be buying time in the market is your best friend. One of the biggest mistakes a lot of people make is they just sit on a ton of cash and they are just waiting to feel ready. They are waiting for the market to drop 30%, then it drops, and then they say they are going to wait for it to rebound. Before you know it, the market's already gone up 200%. Had you just been buying the whole time, you would be in a lot better position. Believe it or not, there is actually a lot of people that don't even start investing until they are 50, and then they are supposed to retire in 15 years and they are just getting started. The sooner you start, the better off you are going to be, even if it's a small amount initially. So always remember that. The fifth decision is what you value. Do you care about your lifestyle now, or do you care about having flexibility in your future? In your 20s, you are young, you have a lot more free time. But a lot of times people try to enjoy their life immediately. They buy a new car and spend a bunch of money on super nice brands. They are taking tons of trips, which may seem fun in the moment, but they don't understand delayed gratification. They spend all their money right now. They have to go spend $300 at the bar. All you have to do is just think about your future self 10 years from now. If you can just delay some things today and you can invest in yourself right now, it can put you in a really, really good position. I know so many people in their 20s that spend all of their money traveling and they don't have any money at all. Some of them have gone into a lot of debt just to do these things. Yes, the memories are great, but the stress they are feeling right now at 30 might not be worth it. There is definitely a balance to these things. You can still invest in travel, but delayed gratification is a really good habit to build early on. When you are prioritizing lifestyle inflation early on, you are sacrificing your flexibility later on. What sounds like a huge win is having enough money in all my investing accounts to where if my boss is pissing me off one day, I can just go, you know what, forget you, I am quitting. That to me is real freedom. The fact that you can do whatever you want with your time is a powerful thing, and if you can truly understand delayed gratification, then you can get to that point. You could be 35 years old and be in a phenomenal position if you have enough money invested by the time you are 35. You could change jobs and go into a job that maybe pays less. But because your portfolio is at $2 million, it's compounding on itself so much that it doesn't even matter how much money you are making because your contributions wouldn't help it. The snowball is already so big. It's rolling down that hill whether you like it or not. As the old saying goes, time is money. But the more money you have, the more time you get back. If you are just constantly upgrading your lifestyle and you never think about what your future self wants, then you could be putting yourself into a pretty bad position as you start to make more money, and that gap gets bigger and bigger. If something does happen that may set you back and you have a huge cushion of cash to sit on, the more assets you have, the more freedom you are going to have. Let's look at a case study that illustrates a better way to find your retirement number. Let's use a 62-year-old couple before retirement. They make $300,000 per year. At this point at 62, they have $2.5 million saved. They are currently spending about $179,000 per year right now. At full retirement age, their Social Security is projected to be about $52,000 per year. They have saved well. They are not reckless. If we use the Vanguard style replacement ratio, a 79% replacement rate on $300,000 of income means we are trying to create about $237,000 per year of retirement income. Using the 4% rule, that points to a portfolio of almost $6 million. Since they currently have $2.5 million, they are not just a little short, they are a lifetime away. It will take them about 11 years to get from $2.5 million to $6 million in portfolio size. But the starting number was wrong. The reason the starting number was wrong here is pretty straightforward. They are not spending $237,000 a year. They are spending $179,000 a year. And even that number is not permanent because about $40,000 of that spending will end up going away 4 years from now. When their youngest child finishes college, you can insert any other expenses there. Maybe mortgages are completed. Research shows all sorts of expenses drop off as you enter retirement. A broad research paper is not going to be good at identifying that part of the spending as temporary. It is not going to know your exact Social Security amounts. It is not going to model a retirement spending smile. When I run this same case through a spending first model, this couple is not 11 years away. They are actually 17 months away under that model. This couple has a probability of underspending the plan's resources above 65%. The conclusion is that once we use the right inputs, we have a completely different decision. The Vanguard style model would tell them to work 11 more years. The spending first model, which is way more accurate because it is their actual spending, says you are close. That produces a 9.5-year difference. Those 9.5 years are not some random theoretical exercise. Those are years where someone may keep working in a job that they are stressed out or unhealthy. The way to think about this is retirement is not funded by one giant number. It is funded by a bunch of slices. Think of it like a pie, and those slices do not all show up at the same time. They do not all get taxed the same way. They do not all behave the same way when life changes. And that's why I like thinking about this like a retirement withdrawal pie chart. This forces us to stop asking what percentage of my income do I need to replace, and it forces us to ask instead what pieces of my withdrawal pie chart are actually going to fund my spending. The first slice of this pie is the spending need itself. Current spending is not always permanent spending. The next step after identifying spending is going to be looking at reliable income sources for most retirees. The baseline is going to be Social Security. For some people, they might also have pensions, rental income, or part-time work. The point is that the portfolio is not the only thing funding every dollar. In our example, this couple has about $52,000 a year of Social Security income, which changes the job of the portfolio. The portfolio is not trying to recreate a $237,000 paycheck. It is trying to fund the gap between what this couple spends in reality and what their other income sources will not cover. And then the next thing we look at is where the portfolio money is coming from. Is it taxable money? Is it pre-tax IRA money or 401k money? Is it Roth? Is it cash? Two households can both have $2.5 million and still have very different retirement plans depending on where that money lives. In the case I showed earlier, they had $2.25 million in pre-tax and $250,000 in post-tax. If we flip that and they had $2.25 million in post-tax and $250,000 in pre-tax, the odds are they could have retired already. That's how impactful the tax location is for the money you have. Real retirement spending is not a straight line. There will be higher spending in early years because people are younger and healthier, they will travel more, and then retirement spending will dip in middle years and then increase as healthcare costs mount. You also want to look at flexibility. Retirement is really about knowing what types of trade-offs you are willing to do. In the case study, Part of the reason they were only 17 months away is because they were willing to make a very small 5% spending reduction if the plan hit a lower guardrail. That matters because it gives the plan a way to respond, and it does not mean they are promising to slash their lifestyle forever. It just indicates that we have an adjustment that is defined ahead of time. So the plan is not pretending the retiree has no need to ever adapt. That's a very different exercise than taking your income and multiplying it by 79% and backing into some huge portfolio number and hoping that works forever. At that point, we are no longer asking, how do we recreate the paycheck? We are asking, what does this specific retirement need to fund, and can the actual resources you have support it? Do not let broad research make household-specific retirement decisions for you. Make sure that the number you are actually chasing is actually built around your actual spending, your actual other income sources, your tax location, and future expense changes. 1929-1965.